Ravi Dharamshi is with us, Chief Investment Officer at ValueQuest Invst Advisors. Ravi, good morning. Great to have you back on the program. Thanks very much for your time. Let's just start with this sort of new age digital themes, right? Zomato, it was a big quarter for them. I think they've turned profitable at least a year before they themselves said they would. Delivery, stocks had a run up. Maybe that's why the view has changed a little bit, but I thought numbers were pretty okay. And then there is this news flow on Paytm this morning. What do you make of the space, Ravi, and any interest at all?
So disclosure, first of all, that I will not be able to speak any stock-specific thing, but overall this space, a lot of value is going to be created over here. The question is of entry point, and question is also that currently the funding winter is going on for the private equity market. So funding is not available if your business model is not in place, if you cannot sustain yourself. With Zomato or whether it is Paytm, it's not about this quarter's profitability, but can that model sustain itself? Can they fund their own expansion through their own cash flows? If that is the case, then I think these are strong business models, especially the food delivery one, because there are literally only two players. It's a duopoly kind of a market. So that is a good, so I would be positively inclined, but full disclosure, we don't own any of those.
Okay, positively inclined. By the way, our colleague Hormuz very helpfully tells us that at this price, Paytm has doubled. Remember, the all-time low was 438 rupees and Paytm is now at 887. So it's doubled from its all-time low. That's been the kind of trajectory the stock has seen. Ravi, hi, good morning and thanks for joining in. By the way, all of these platform companies, right, even Zomato is at, I think, a 20-month high as we speak. So all of them have come back in a big way. But having said that, how are you feeling about the market now, Ravi? What is the, the sense that you're getting? Is there a little bit of caution on board after what we've seen up until now? Or do you think this run can continue?
So I think we are in the early stages of the business cycle and market is tracking that. So, but surely nothing can move up, in one direction all the time. So we will find our reasons to have a shakeout, to have a correction. 5-7% kind of a correction cannot be ruled out. So maybe this is, the spike in the bond yields in US or RBI decision coming up. Those can provide the reason the market is looking for some consolidation correction. But having said that, I think the larger uptrend is solidly intact. There is not a single sign that, we are out of whack in terms of valuations or so there's too much euphoria on the street. If you see, the IPO market has pretty much not revived as of now. In fact, second half of this year, I think we'll have a lot more activity on the IPO front. So I feel confident that market's trajectory will sustain with a step back at best.
All right. Hi, Ravi. Good morning. Good to hear your thoughts as always. The chemical space was the big re-rating event that took place in the last 2 years or so. Now, we've got a few numbers that have come in and clearly there are signs that things are slowing down. Offtake is reducing. That entire India, China plus one themes, some part of it seems to have played out. In the near term, do you think some of these stocks have already played out some of that good news? I ask you this, I think you'll have some exposure in specialty chemicals.
So we are completely out of specialty chemicals. Okay, we might own a little bit, but essentially, specialty chemicals has gone a re-rating not only in last 2 years. It's gone from 2014 to 17. The entire sector has gone 20x up. So the China plus one theme is well and truly recognized. It's not a surprise anymore. In fact, what the surprise is that the China has come back to the market in a big way and supplied the market. So again, in the larger trend of China plus one, chemical was the first one to move, and I believe it is the first one to be correcting as well, both from the point of view of valuation as well as the business. But having said that, despite some of the negative results that are coming out, it's not like the stocks are crashing. So that tells you that overall the market still believes in the story, and at some point of time, maybe it will be time to re-enter the sector.
But not now, Ravi. That's what you're saying, right? Even if you
Definitely not.
Definitely not.
Yeah, I think there is a margin issue, there is a growth issue, and some amount of China plus one story is reversing because the China is coming back into the market. This will separate the men from the boys. Let's see who has the resilience to continue growing during tough conditions. So and also to maintain margins. So I think this is a good period to keep your eye out on which one are the ones doing relatively better, and those will be the ones to bet on, but not right now. At least not for few quarters, I feel.
Okay, got that. The other, I'm just kind of looking at bombed out places, is the QSR space, Ravi. Any interest there? And, we heard the seasoned investor pitch Jubilant Foodworks as an idea. I mean, the grand old daddy, which has been out of favor for a while now. Any thoughts?
See, so first of all, I think market is very, very nuanced. Post-COVID, export-oriented sectors did very well. And then those kind of dissipated as the global economy slowed down. Then the domestic-facing sectors started doing well, especially the consumption-oriented, because there was revenge travel, people started ordering at home and dining out, both those things. So that led to the consumption-oriented stocks doing well. In fact, some of them are probably still doing well, like hotel and all. However, even that is now kind of normalizing. So every sector is going through its own cycle post-COVID and normalizing. I think QSR is 2-3 quarters already into the normalizing, and that the reason because of the operating deleverage, and these sectors are very high on operating leverage or deleverage. If there is a slowdown in growth, they face operating deleverage, so the margins are impacted. So they are going through one such phase, and I believe this would be a good time to be accumulating. I don't expect the stocks or the sector to start doing well in a quarter's time, but these are all-weather companies, and you should be accumulating them during bad times. So this is one such temporary issue that we are facing in the sector, and we should be looking to add.
Okay, I wanted your thoughts also on what's happening in the auto space, particularly with names like M&M, right? Very strong numbers coming through, margins at multi-quarter highs. And the company has also assured investors that they will stick to their prudent capital allocation policy. What do you do at a time like this? Do you think there could be disproportionate gains on some of these names?
So without commenting on a particular company, but I would say is that, auto cycle has also been on a revival. Whether it is PVs, two-wheelers, CVs, or even tractors. Tractor, in fact, probably might be towards the end of its down cycle now, with the revival expected in the rural cycle. So various segments of the auto are at a different stage. So CV cycle has been in upswing since almost 2 years now. Tractor cycle is probably going to begin its upcycle going forward. So I would say from a PV point of view, the trends are, you have to look at what the sub-segment trends are. The trend is towards SUVs. In e-two-wheelers, there is kind of in two-wheelers, the bump is that e-two-wheelers the subsidies have been reduced. Now there are lots of launches lined up, and government will come up with some new regulation. So the space is still evolving, and we need to see. And in terms of the CV cycle, I would say the major threat is from the longer term perspective that we want to move towards railway. If we want to bring our logistics costs down from 14% of GDP to 8-10%, then we have to move away from auto as our mainstay of logistics. So incrementally, there will always be a challenge on the CV front is what I feel.
All right, Ravi, final question before we let you go. There's a lot of interest in the renewable energy space, the solar power themes as well. I think in the unlisted space, Waaree Energy is something that, y'all have some exposure to. So tell us about this theme. How do you see it playing out from here, and what's the potential?
See, leaving the ideological questions apart, whether, fossil fuel we should get rid of, or what should it be replaced with, or whether renewables have the capacity to replace fossil fuel. You have to think of it this way. We have been exploiting the Mother Earth's resources since almost 200 years now, since the dawn of industrialization, and we have accelerated the process of global warming as a humanity, and we need to slow that down. So we need to move towards circular economy, and we need to move towards sources of energy which are abundant in nature, which is sunlight and wind. So no doubt about it that we will move towards renewables. Now within that, solar is the cheapest source of energy ever available to humankind. I mean, besides the fact that you could create fire by rubbing stones, this is the cheapest form of energy available. And now there is a strong momentum from the governments, from the corporate sector, from the individuals. Everybody is now working towards moving towards reducing their carbon footprint and moving towards renewable. So I think the critical point in the movement has been passed, and now the momentum gathers pace. And there is no denying that this is going to be the sunrise sector, no pun intended, from the next 10-20 years point of view.
Okay, all right. Ravi, thanks a lot for stopping by and giving us your views on a whole host of sectors.